Hello, hello. So I think it's safe to say that 2025 was an absolute monster year for anything tied to AI and semiconductors. For example, Nvidia was up about 39%, still dominating the AI chip game despite some wild swings. Broadcom and the Van Eck Semiconductor ETF both crushed it with nearly 49% total returns each. Micron absolutely exploded, up around 240%.
Damn!
On skyrocketing demand for AI memory chips like HBM and DRAM, 2025 was pure AI momentum and it was printing money left and right. But not every semi stock got the invite to that party. While those AI darlings were mooning, one name was heading in the complete opposite direction, sliding hard, testing deep lows, and spending 2025 in recovery mode instead of breakout territory. Which brings us to today's video. We're talking about STMicroelectronics, stock ticker STM. This one reminded us that not all semis are riding the same AI wave. Shout out to Chuck for suggesting today's video. STM once traded near $53 to $55 per share at its all-time high in mid-2023, and since then it's been under significant pressure. Fast forward to 2025, STM started the year struggling and then slid into 52-week lows, dropping as far as about $17.25 a share. Today, at the time of recording, the stock trades at just under $30 per share. As STM slowly works its way back into the 30s, the AI value narrative is starting to pick up. But is this actually a hidden opportunity, or is STM a cheap stock for a reason? To find out, we need to break down what went wrong with STM, why the stock suddenly looks cheap, what management is doing about it, and where this thing could realistically go next. But first, I want to say that if you trade on Robinhood, you might not see this stock. STMicroelectronics is not a US company, it's a European semiconductor company headquartered in Switzerland. The main listing trades in Europe, but in the US it trades as an ADR, which stands for an American Depository Receipt on the New York Stock Exchange under the ticker STM. Think of an ADR like a foreign movie with English subtitles. It's the same company, just packaged so US investors can watch it in their own market in dollars during US hours. That's also why some brokerages, like Robinhood, doesn't always offer STM. It's not a red flag, some platforms just limit foreign securities or ADR custody. If you're on one of those OG brokerages like Fidelity, Schwab, or TD, you'll usually see it just fine. And one small thing to know, ADRs can have tiny annual fees. For STM, it's usually just a few cents per share per year automatically deducted by your broker. Again, not a deal breaker, just something long-term holders should be aware of. All right, now let's talk about why STM stock fell apart heading into 2025. The first hit came from STM's 2024 earnings, which were rough across the board. Revenue dropped more than 20% year over year, profits fell sharply, and margins basically got cut in half. That alone reset expectations, but the real damage came from what happened next. STM's guidance for early 2025 delivered a stark reality check. Q1 revenue was expected around $2.5 billion, a huge year-over-year and sequential drop. Gross margins were projected to shrink further, largely because factories weren't running anywhere near full capacity. For a semiconductor company, that's brutal. Underutilization crushes margins, and it wasn't just one problem. STM's two biggest markets, automotive and industrial chips, were both weak at the same time. EV platforms, industrial machines, car makers, and factories were all slowing orders as they worked through excess inventory. Management even called 2024 one of the worst years they'd seen in decades for these segments. From an investor's perspective, this wasn't just a bad quarter, it looked like a full-blown cyclical downturn with no clear bottom. The stock reacted fast, nearly a 10% drop in a single session. Analysts cut estimates, price targets came down, and STM slid to levels it hadn't seen since around 2020. And to be clear, this wasn't just STM. The broader analog and industrial semiconductor space was struggling too, but STM got hit harder because of its exposure to auto and industrial demand, right as those markets slowed simultaneously. Even later in 2025, margins remained a concern.
I'm tired of this, Grandpa!
That's too damn bad! You keep digging!
S&P cut STM's credit outlook to negative due to weaker cash flow. Analysts pointed to continued revenue decline in 2025 before any normalized growth returns in 2026. This reinforced the narrative that the company was in a deeper cyclical trough rather than a shallow dip.
Uh-oh.
Don't tell me. We're about to go over a huge waterfall.
Yep,
Sharp rocks at the bottom?
most likely.
Bring it on.
And that's how you end up with a stock down over 40% from its highs, even while AI-focused semiconductor names were ripping. However, it should be noted that despite the brutal mid-year 2025 drawdown, STM actually managed to finish 2025 up roughly 7 to 8% on the year, bouncing off its lows as the broader market recovered.
I didn't hear no bell. One more round.
It's a reminder that STM isn't totally down for the count. The stock bounced off its lows and finished the year positive. Still, the mid-year sell-off tells the real story: weak earnings, cautious guidance, and slowing auto and industrial demand. But a stock can't continue to climb, at least not for long, without a plan, and STM isn't just waiting for the market cycle to turn. They've already started making strategic moves to dig themselves out of this rut, and some of these could become real long-term catalysts if they execute well. First up, silicon carbide, or SiC power semiconductors. This is a big growth area for EVs, renewable energy, industrial power systems, and charging infrastructure. STM is pushing into larger wafer sizes and high-efficiency SiC production. Why does that matter? Because SiC chips are more efficient and higher margin than traditional silicon-powered devices, and EV makers, especially in Europe, are increasingly demanding them. If STM can scale SiC production and win design slots with major EV automakers, that's a structural revenue driver. STM isn't building Nvidia-style GPUs, but they are building chips that run AI at the edge, meaning STM makes chips that help devices do smarter things on their own. Their STM32 microcontrollers now include neural processing units, letting devices handle vision, audio, and decision-making locally. That means smart sensors, robotics, Internet of Things gadgets, and industrial automation can all think on their own. It's not flashy, but once STM gets a design win, they have a potential for consistent revenue. STM also supplies key radio frequency chips for Starlink terminals and phased array antennas. Now, this next part is purely speculative, but if Starlink ever goes public, that could do more than just grab investor attention. It could potentially drive growth for STM too. Why? Well, a Starlink IPO could fund faster satellite deployment and bigger network expansion, which means more terminals, more antennas, and ultimately more chips shipped from STM. It's speculative, sure, but it's a real pathway where a high-profile tech IPO could indirectly boost STM's revenue. STM is working with AWS on photonics chips. Think of them like super-fast highways for data inside cloud and AI systems. They move huge amounts of information quickly and efficiently, which is exactly what's needed as AI workloads keep growing and demand more speed without using extra power. On the operations side, STM is reshaping its factories by cutting less profitable capacity and focusing on high-value processes like SiC and advanced packaging. Part of that push includes panel-level packaging, which lets them package chips at scale on larger panels instead of individual wafers, reducing costs and boosting efficiency. Even though restructuring can hurt short-term profitability, it's an important step for long-term margin improvements once volumes recover. On the financial side, STM has authorized share buybacks and emphasized disciplined capital allocation. They were buying back shares in early November 2025 at roughly $22 to $23 per share, and in October around $23 to $27 per share. That doesn't drive revenue, but it does support the stock in weak patches and signals that management believes the shares are undervalued. So STM is making a lot of moves to recover. These kinds of changes can drive long-term value, but it also raises a bigger question. With all this in motion, is STM actually an AI play? Can it ride the AI wave like Nvidia or AMD, or is this more of a slow, steady value story? Well, the answer isn't exactly straightforward because STM isn't a pure AI chip company. In other words, they're not making GPUs that power massive data centers, and they aren't designing AI training processors. What they do make, though, is chips that run AI at the edge, meaning inside devices, industrial equipment, robotics, and Internet of Things. As mentioned earlier, their STM32 microcontrollers now include neural processing units that let devices think locally. So yes, AI is part of the story, but it's a very different kind of AI exposure than what most people think of when they hear the term. On top of that, STM's photonics chips for cloud and AI data movement could indirectly benefit from AI demand in the data center space. It's not glamorous and doesn't really sound like fundamental catalysts that could blow up overnight, but it does tie the company to AI trends. So if you're expecting a Nvidia-style AI boom, STM is not really that. But if you're thinking about the broader AI ecosystem, chips that enable AI on devices and move data efficiently, then STM is quietly part of that growth story. Speaking of growth, let's now look at the latest analyst forecast. Fair warning, opinions are mixed, and that kind of tells you a lot. The 12-month consensus price target is roughly $31 to $32, implying roughly 8 to 10% upside from current levels. Targets also range widely from lows around $24 to a high of $45, showing uncertainty around timing and fundamental improvement. So most analysts aren't calling this an explosive rebound, more of a grind higher if things improve structurally. There are also cautious views on STM, and they're worth explaining. Again, some analysts have targets as low as $24. This is largely based on slower recovery assumptions and continued margin pressure. STM's stock price could drift lower if demand remains soft from muted end market orders and persistent inventory buildups. Semiconductor stocks tend to move in cycles, and they can stay down longer than people expect. STM is extra exposed because a lot of its chips go to cars and industrial machines, markets that don't necessarily bounce back quickly. Downside risk isn't gone, and some analysts are pricing that uncertainty into the lower targets. So is STM a high-flying AI stock? Well, the evidence suggests not. But is it a potential value play in a tech sector that's otherwise soaring? Maybe. Either way, it's absolutely something to watch. And just a heads up, this is my personal take on STM, not telling anyone what to buy or sell, but I could definitely see myself taking a chance on it if I could get a cost basis of around $25 to $28 and then trade that up to $29.50. If it breaks that level, we could see it climb to around $30 to $31, and if momentum and technicals line up, maybe even $33. Looking longer term, if catalysts like EV, SiC chips, photonics, embedded AI, and potential Starlink growth play out, $45 isn't out of the question. On the flip side, if the industry stays weak, the stock could drift to the low mid-20s. Well, there you have it. STM's got some chips stacked in its favor, but only time will tell if it flips the script or stays in the fryer. If you found this breakdown helpful, go long on the like button, subscribe, and let me know in the comments. Do you think STM has what it takes to turn this around, or is it a value trap waiting to happen? Remember to trade gingerly, and I'll see you in the next one.